Hello UPSC aspirants, hope you're doing fine. Today we are going to talk about an interesting topic in the economy, that is about Reserve Bank of India. I will ask you a few questions. Why do we need a central bank? Why can't the government itself do the supervisory and the regulatory operations of the banking system in the country? Why do we need separate entity other than the government to look after the banking system? And how do you think the RBI can regulate the monetary policy and control the currency system in the country? How do you think RBI plays a critical role in the growth of the economy as well as financial stability of the country? How do you think the RBI can play a bigger role in this? If you know the answer, please write those answers in the comment section of this video. If you don't know the answer, you will find the answers in the explanatory video of this. Let us come to today's session of Reserve Bank of India. The Reserve Bank of India was established in the year 1935 under the recommendations of Hilton and Commission of 1926. It is RBI is established under Reserve Bank of India Act 1934. This act is very important as the RBI gets its powers from RBI Act 1934. Then the RBI is completely owned by Government of India. What are the functions and the roles of the RBI? If we can know the functions and the roles of the RBI, then it is easy to understand why do we need a special entity called Reserve Bank of India. Why not the government? Why we needed a separate entity for the banking system supervision and the currency system regulation. So come to functions of RBI. The first and very important function of RBI is issuing currency notes. What does it mean? It means the RBI prints the fresh currency notes and infuse into the economy. Under what conditions the RBI prints fresh notes? The first condition is to replace the old notes, to replace old and damaged currency notes. And the next condition is to improve the security of the notes, to improve the security of the currency notes. What is the third condition? Whenever the economy grows, we need fresh currency infused into the market. So whenever economy grows, RBI resorts to print fresh currency notes. And the fourth condition is to lend to government. Previously, the government resorted to printing fresh currency notes whenever there is a high fiscal deficit. To finance this fiscal deficit, government used to order the RBI to infuse fresh currency notes or to lend that fresh currency notes to the Government of India. But this has been prohibited by FRBM Act. So these are the three conditions under which the fresh currency notes can be printed by the RBI. In demonetization condition, the fresh currency notes are infused, but the value of the currency in the market remained the same. Only thing is whatever the currency notes are there that are taken by the RBI, and in place of them, new currency notes with improved security had been infused into the market. So under these conditions, the RBI can print fresh currency notes. And there is something called coins, minting of coins. This is done by Government of India, not by RBI. Government of India completely controls the minting of coins, but RBI doesn't. After minting of coins, these are distributed by RBI. When the RBI is printing fresh currency notes, the design and the denomination both are done by Government of India. Design and denominations are decided by Government of India. Printing is done by RBI. RBI can print up to 10,000 rupee denomination. This is given under the RBI Act 1934. And the second function of RBI is government's banker, agent and advisor. What does it mean? On behalf of Government of India, RBI receives and makes payments. RBI receives payments and makes payments on behalf of Government of India. And RBI maintains deposit account of Government of India. The public debt of Government of India is also managed by RBI. And the issuing short-term loans to Government of India is done by RBI. What does RBI do? As a banker, agent and advisor, RBI receives and make payments on behalf of Government of India. RBI manages public debt of the Government of India. RBI maintains deposit account of Government of India. RBI gives short-term loans to the government, and RBI advises to the government on any monetary policies or any banking policies. RBI advises to the Government of India. RBI also issues treasury bills, government bonds in open markets on behalf of Government of India. There is something called open market operations by RBI. What does that mean, open market operations? Here itself we are knowing RBI is coming into the market and doing some operations. What does that market here? Mostly, especially banks and other financial institutions. These financial institutions can be investment banks, housing loan banks, NBFCs, non-bank financial companies. So to all these banks and other financial institutions, RBI sells or buys government bonds. This is called open market operations, which you call as OMO. RBI sells or buys government bonds or treasury bills. There is always a fiscal deficit to the Government of India. Why there is a fiscal deficit? The expenditure is greater than the income of government. Then we get the fiscal deficit. In order to finance this fiscal deficit, what RBI does is open market operations. That is, RBI sells government bonds. In return, what does it get? Money. It's just a bond saying that in future you would be getting some interest. In place of these bonds, RBI gets money and it gives that money to the Government of India to finance this fiscal deficit. See, when to finance this fiscal deficit, RBI has two options. One is selling government bonds. Other is printing new currency. Printing new currency. But this has been prohibited by FRBM Act. It is RBI is the custodian of forex reserves of Government of India. The foreign exchange reserves, that is foreign currency, gold, IMF's special drawing rights, SDR, all these are under forex reserves maintained, or the custodian of this forex reserve is RBI. I told you one of the functions of RBI is to print money. So when RBI is printing money, what are the conditions that it take into the account? It takes, first is requirements of economy. When economy grows, more money has to be supplied into the market. How much money is to be supplied? When economy grows, how much money has to be printed by the RBI? That has to be decided by the gold reserves, forex reserves, and already in the market, the liquidity available in the economy. So by considering all these things into account, RBI prints money and infuses into the market. Since we have talked about open market operations, let us talk about another scheme called market sterilization scheme. What is this scheme? Under this scheme, RBI withdraws money from the market. RBI withdraws money from market. How does RBI withdraws money from the market? There are some special bonds called as MSS bonds. MSS bond issued by RBI. And these bonds are sold by RBI in the market. Whenever it is sold, the money from the market goes to RBI. RBI say market. RBI gives bonds to market. Market gives money to RBI. So whatever the money that is there in the economy, that has been withdrawn by RBI and stays with the RBI. This MSS, whatever the money the RBI gets through this MSS bond, that stays with RBI. Doesn't go to Government of India. So what are the conditions under which MSS bonds are issued by RBI? The first condition is during very high inflation. What is inflation? Rise in prices. So if we decrease money supply in the market, the prices decreases as the demand decreases. So in order to decrease this money supply, what RBI does is MSS bonds and sucks the money supply into the RBI. That is the reason why RBI doesn't give this money to government. If RBI gives money to Government of India, what happens? Government again infuses it into the market. What is the purpose of MSS bond then? So that is the reason why the money withdrawn through MSS bonds kept with the RBI. And the second one is to stabilize rupee value. So sometimes in order to buy dollar from the market, RBI prints notes, prints fresh currency notes, fresh currency notes. But it is the requirement of RBI to buy the dollars, but it is not the requirement by the economy to print notes. Economy is not giving or necessitating the RBI to print notes. Just RBI wanted dollars. In order to get dollars from the market, RBI is printing rupee. If this rupee goes into the market, it will cause high inflation again. If economy requires printing of rupee, then fine, there won't be any inflation. But it is a necessity of the RBI to get dollars. It is printing rupee and releasing into the market. Since this move is inflationary, RBI issues MSS bonds and sucks in money from the market. Thereby, there won't be any inflation due to this RBI act of printing fresh currency to buy dollars. That is what sterilization means. Sterilization means taking the money from the market, which is done by RBI to stabilize the economy or to control the inflation by increased money supply in the market. Till now, we have seen how RBI is a friend to the Government of India. Now, we will see how RBI is friend to the banks of the country or is regulating the banking system in the country. So, let us come to third function of RBI. That is, RBI is banker's bank. What does that mean? All the banks in the country puts cash reserves in the RBI. These cash reserves are called as CRR, SLR. And next is RBI is called as National Clearing House. RBI facilitates smooth interbank transactions. For example, I have an account in Axis Bank. I want to do payment to a person who has account in ICICI. How it happens? From Axis Bank, the payment is done to RBI and RBI clears this payment to the ICICI. That is how RBI ensures smooth interbank transactions. RBI can receive or make payments on behalf of banks, right? RBI receives and make payments on behalf of banks, especially for smooth interbank transactions. And the fourth function of RBI is, it is the lender of last resort. What is this means? Whenever banks need credit, bank needs credit. What does it do? It either take from market or it take from other banks. But sometimes even the market and other banks can't give loans because of less supply of money. That times RBI comes as a last resort to the bank and give loans. You can say LAF, MSF, liquidity adjustment facility, marginal standing facility. Under these names, the banks receive credit from RBI. Why RBI gives credit to the banks? What is the reason? The first reason is to protect the depositors. It is the depositors' money that is at stake if the bank fails. RBI never wanted bank to fail because of minimal amount of money. And the next is cascading effect. To avoid cascading effect. What does it mean? Sometimes what happens is, if a bank fails, other banks are prone to fail, because whatever generally in the market what happens is, if one of the bank fails, let us say X bank is about to fail, then what happens is all the depositors in Y bank, Z bank, they also go to these banks and try to take out their money at the same time. Then the banking system is supposed to collapse. Because of X bank, Y bank and Z bank also get affected. They also become bankrupted. That is, in order to avoid this cascading effect, RBI tries to lend money to the banks. And the fifth function of RBI is controller of credit in the market. What does it mean? The volume of credit, the rate of credit. Both are controlled by RBI by using the tools of open market operations, repo rate, and cash and reserve requirements. What are these reserve requirements? CRR and SLR. What does it mean, controller of credit? Whatever the money the bank get through deposits, from the deposits only the banks can give loans. If the amount of money, for example, if the amount of money that the banks has is decreased, how the bank's money can be decreased? By increasing CRR and SLR. If I increase CRR, SLR, the banks has to keep lot of money with the RBI. If I do open market operations, what happens? In open market operations, RBI gives bonds to the banks and the banks gives money to the RBI. Thereby, the money in the banks can be lessened. And the sixth function of RBI is, it is supervising and control the banks in the country. How it supervises? How does it do supervising and control of banks? By granting licenses, periodical reviews, regular inspections. Sometimes it gives directives to the banks. RBI assesses health of the banks. By analyzing all the roles and functions of RBI, we can also come to a conclusion that the main things that RBI has to do is control inflation, right? Control inflation for macroeconomic stability. This is the first outcome that we see by the functions of the RBI. The second outcome by the functions of RBI is maintaining good financial health in the economy by being friend to the banks. What do you mean by financial health? What does bank do? They take deposits and they give loans from the deposits. So good financial health means depositors feel safe to keep their money in the banks, and the people who require loans can get loans from the banks. That is what good financial health means. One is controlling inflation. How does it do? By doing open market operations, by fixing repo rates, which right now is taken by Monetary Policy Committee. And in that, RBI has also representation. And reserve ratios, which are nothing but CRR and SLR. I already told you, for printing money, economy requirements and the present reserves, these two are taken into account and then print money. So for this, what we need is a specialization. How much money has to be printed is decided based on some equations, some formulae, considering the economic requirements and the present reserves. Those are gold reserves, forex reserves. By considering those things, we have to print money. The RBI has to print money. For that, it needs some formula equation, which is nothing but specialization. For all these reasons, the government of India has established RBI as a separate entity. Government cannot control inflation. Why? Government always has fiscal deficit. It always prone to print money in order to finance fiscal deficit, which is highly inflationary. If there is a specialized agency, say RBI, then it can control inflation by giving loans to RBI through open market operations, by having reserve ratios, reserve requirements from banks. So for this reason, Government of India has established RBI, and RBI plays a critical role for macroeconomic stability as well as financial health of the economy. Hope you understood the concept pretty well. If you like our video, please subscribe, share and like our channel.